Welcome to The Deep Dive, where we break down the most important earnings calls to give you the insights that matter.
Today, we are digging into Advanced Drainage Systems, ticker WMS, and their Q2 Fiscal 2026 earnings call. And this wasn't just, a good quarter. It was a statement quarter.
A statement quarter. I like that. So our mission here is to really get under the hood, figure out what drove this incredible performance and why the market reacted, well, so explosively.
Exactly. We need to connect the numbers to the strategy.
Okay, so let's set the stage. The call was on November 6th, and the stock just ripped higher. It closed up nearly 9% on the day.
Yeah, and on really heavy volume, too. That tells you the big money, the institutions, they were paying very close attention. And they liked what they heard.
So this wasn't just noise. It signals a real belief that the company is kind of fundamentally changing.
It is. So let's just jump into the headline numbers. You can see right away why everyone got so excited. Revenue came in at $850.4 million.
Which is 8.7% growth year over year. Not bad at all.
Better than not bad. That beat consensus estimates by about 6%. Wall Street was looking for something closer to $802 million. So a solid top-line beat.
But the real story, as it often is, was further down the income statement. The revenue beat was like the opening act. The headliner was profitability.
Oh, absolutely. The main event. Adjusted EPS was about $1.97.
And to put that into context for you, that wasn't just a small beat. That crushed the consensus by somewhere between 27 and 34 cents.
It's a 15 to 20% outperformance on earnings. I mean, that is just a massive, massive beat.
And you see that power in the EBITDA number.
You really do. Adjusted EBITDA hit $287.5 million, up over 17%. But here's the killer stat. The adjusted EBITDA margin reached 33.8%.
33.8. That's an expansion of over 200 basis points from last year.
Yeah. For a building products company in this environment, that kind of margin makes WMS a complete and total outlier. They're in a league of their own right now.
So that's the central question then, isn't it? How did they pull this off when so many of their peers are, struggling with costs and inflation?
It really boils down to two things working together. First, just fantastic execution on price versus cost. And second, a much, much richer product mix.
Okay, so let's break that down. Price cost first.
Right. So management was clear that pricing is stable, which is great. But the real win was on the cost side. They had better than expected resin costs this quarter.
Which is their main raw material.
Exactly. And this wasn't just luck. This is smart supply chain management. And they were able to convert that cost advantage into real profit across every single segment: pipe, allied products, and Infiltrator.
So it wasn't about squeezing the customer. It was about managing their own internal costs. That feels much more sustainable.
Infinitely more sustainable. And that brings us to the second point, the product mix. This is the long-term structural change that's happening.
They're selling more of the high-end stuff.
Precisely. Look at Infiltrator, their onsite wastewater business. Revenue there was up over 25%.
25%. Wow. Now, some of that was the Orenco acquisition, right?
It was, yeah. But even if you strip that out, organic growth was still a very strong 7%. That's driven by their tanks and their advanced treatment systems. These are high-value engineered solutions.
And you compare that to their other segments.
The contrast is stark.
Yeah.
Their domestic allied sales, which includes things like storm tech retention chambers, that was up 13%, also very strong.
Okay.
But then you look at their traditional domestic pipe business. It only grew 1.6%.
Just 1.6.
Yeah. Strong growth in their high-performance pipe was basically wiped out by weakness in the ag market. So it just proves how smart their diversification strategy has been. The margin beat is all about selling less of the low-margin stuff and more of the high-margin stuff.
It's the strategy in action. Okay, let's pivot a bit. To pull off this kind of strategy, especially with M&A, you need a strong balance sheet. You need financial firepower.
And they are, as you said, swimming in cash. Year-to-date free cash flow was almost $400 million.
So the business is just a cash machine right now.
It's an absolute cash gusher. And that flows directly to the balance sheet. Net debt is only about $618 million. And that puts their leverage at, get this, just 0.7 times trailing EBITDA.
0.7.
I know. It's almost unheard of. Most companies in this space run at 2.5, maybe 3.5 times leverage. 0.7x means they have a fortress balance sheet and, frankly, a war chest for more deals.
And they're already putting that war chest to use with the NDS acquisition.
A big one. A $1 billion all-cash deal for Norma Group's water management business.
So what does NDS actually do for them? What's the strategic value here?
It's a fantastic fit. NDS is huge in residential stormwater and irrigation products, so it gets WMS deep into the retail and landscape channels where historically they haven't been as strong. It's a whole new distribution avenue for them.
And what about the financials of the deal, the synergies?
Management sounded super confident. They're targeting about $25 million in annual cost synergies within 3 years.
Okay, that's the cost side.
But the real juice, I think, is on the revenue side. The commentary was all about how NDS and WMS products are often installed right next to each other, so the cross-selling opportunities are just massive. They expect this deal to be accretive to EPS in year 1.
So, an amazing quarter, a transformative acquisition on the way. It all sounds fantastic, which makes it a little strange that management sounded so, I don't know, cautious about the second half of the year.
That is the key puzzle here, isn't it? Reconciling this blowout quarter with their, let's call it intentionally conservative guidance.
They did raise guidance, to be fair.
They did, but only modestly. They bumped up the full-year sales outlook to the $2.90 to $2.99 billion range. And EBITDA guidance went up to $900 to $940 million. That's about a 5% raise at the midpoint.
Which, after a 15 to 20% EPS beat, feels a little light. So are they just sandbagging, or is there a real reason to be worried?
They pointed to one major risk: demand. Just general demand and market strength. They called out a few things specifically.
Like what?
Well, first, seasonality. The winter months, November through March, construction just slows down, especially up north. That's normal.
Sure.
Second, just general market friction, uncertainty around interest rates, how that hits housing. And third, something interesting. They said the recent government shutdown created delays in getting some infrastructure projects released for shipment.
So it's all volume-related concerns. It's not about their margins or their execution.
Exactly. That is the critical distinction. They said point blank that they expect the favorable price-cost dynamic to continue. The cautious outlook is purely a function of their volume assumptions. They are protecting against a macro slowdown, not an internal problem.
That makes a huge difference. The company is structurally healthier, even if the market gets choppy.
And a long-term story, the secular tailwinds, they are still completely intact. Climate change, urbanization. We have this massive societal need for better water management. And WMS is converting the world from concrete to engineered plastics. That's a story that will play out over decades, not quarters.
Which brings us to our segment.
This is not financial advice. A quick reminder, we are not financial advisors. This is just an interesting, maybe even outrageous trade idea for discussion purposes only. Please don't run out and do this without your own research.
Okay, disclaimer delivered. The setup here is fascinating. You've got this company that is executing flawlessly.
33.8% EBITDA margins.
But management is being super conservative on their volume outlook for the back half of the year.
They're tapping the brakes hard on expectations. And they have a history of doing this, especially with H2 guidance because of weather uncertainty. The trade idea is built entirely on the belief that they are, sandbagging.
So you're betting against management's own caution.
You're betting on their execution. The pitch is to buy out-of-the-money call options that expire right after their next earnings report, so sometime around early February 2026.
Highly leveraged, specific timing. What's the catalyst?
The thesis is that the volume slowdown they're bracing for just won't be that bad. Maybe we get a milder winter than expected, or maybe the initial wins from the NDS integration start showing up faster than anyone thinks.
And if that happens,
if volume just comes in a little bit better than their worst case scenario, the model explodes to the upside because their margins are locked in. A small volume beat would lead to a huge EPS beat.
And the stock would likely surge again.
It would likely retest those highs we saw after the Q2 call, around $153. This is a pure bet that operational quality will win out over temporary and arguably overestimated market friction.
A really interesting structure, betting on execution over guidance.
It's a high conviction play on a high quality company.
Well, that just about wraps up our deep dive on WMS. The takeaway for me is clear. This quarter proved their strategic pivot from a cyclical pipe maker to a high-margin water infrastructure platform is not just a plan, it's happening.
It's real, and it's generating a ton of cash. And that cash, combined with that incredibly clean balance sheet, leads to the final provocative thought we want to leave you with.
Go on.
With 0.7x leverage and cash piling up, will management stay this conservative? Or before the NDS deal is even fully digested, will they use that immense financial power to hunt for an even bigger target? They have the capacity to truly reshape this entire industry.
Food for thought indeed. Thanks for joining us on the deep dive. Keep digging, and we'll see you on the next one.